Welcome to another one of our Money Talks videocasts. I'm Jerry Slusowicz, your host. We update these videocasts on occasion when we see kind of major turns in the market. Well, it is Wednesday, August 3rd, and we are testing market support. It's very important. The market pretty much has gone sideways throughout the year. We went up, down, up, down, up, down, up, down. The lows after the earthquake in March in Japan and tsunami. We had another low in June, and now here we are early August, and we're right back down around the 1249, 1250 mark on the S&P 500. The NASDAQ and the Dow are following suit. The small cap index, the Russell 2000, has already broken down and is signaling more trouble ahead. Now, with that said, we've been down 7 days in a row. With this morning's down, we're down the eighth consecutive day. We haven't seen a down streak like that since October 2008, so almost a couple of years, and that was some pretty rough times. But the federal government did get this debt ceiling thing resolved in the fact that they're solving a debt problem by creating more debt. It's akin to someone who's maxed out on their house. They've taken all the loans they could. They're maxed out on all their credit cards, and they're saying, geez, we don't have any money to pay our bills. What should we do? And just then they receive a mailer that says, here's a new credit card for another $50,000 for you to spend. And they say, wow, all our problems are solved. I think most Americans have figured out that this may not be a good solution to our debt problems, is increasing the debt ceiling. In addition, we've seen things like the GDP, gross domestic product, which is the look of the output of the United States total markets, and it's down from what they estimated at 3% growth to less than single digits for the first half of the year. They're lowering the forecast for the second half of the year. J.P. Morgan just did the other day to also single digits. A lot of these assumptions for this debt ceiling is showing 3% growth. If we don't get that 3% growth, our debt problems are going to increase. In addition, things in Europe are getting more and more dicey. Italy and Spain are now showing weakness. That contagion is spreading and spreading to other countries. There is not enough money to bail out Italy or Spain in the Euro nations. It is also anticipated that Ireland's going to come back just like Greece did for a second bailout and ask for more money. So there is a global issue of a slowdown and a debt issue globally that has not been resolved yet, dating way back to 2008. The federal government, Ben Bernanke, is going to do everything he can to try to prop up the markets, but here we are. Quantitative easing 2 ended at the end of June, started in about mid-November, and the markets year-to-date are actually slightly down, so it's going to be questionable what they can really do. What really has to happen is our government, our state governments, corporations, and individuals have to learn to live within their means. What a concept that is. You need to spend less than you make. And until we can get that under control, basically many individuals, baby boomers, all the way on up to corporations, state governments, federal government, are living beyond their means. And unfortunately, that's going to be a contraction in the economy and a slowdown, which could mean falling stock prices. I'm not saying it's going to happen right away. The Fed is always the wild card. Hopefully, we're oversold. We get a little bit of a bounce back up to the 50-200 day, and it'll allow those investors who are still long to maybe reduce some exposure. We've done a good job. We own a lot of bonds. We've done very well with those because it's a flight to safety. We own gold, silver, the miners, and we own foreign bonds because guess what? The foreign emerging markets in particular are not as indebted as we are. We're 80% to 100% in debt for the developed Europe and Americas, where the emerging markets are less than 40% to maybe only 20% indebted based on their GDP. So there are areas that are working. You don't have to ride the cycle up and down. It is possible to make money in a down cycle. It is possible to protect your capital using stop losses, something I've employed here at Pacific Financial Planners since the year 1990. For more information, if you want a free portfolio review, call toll-free 800-449-9501. That's 800-449-9501. Or sign up for our free email newsletter. It comes out typically every Friday. It's a podcast or some written materials. Sometimes we update it more frequently than that. Right here on our website, www.yourmoneytalks.com. It says free newsletter. Again, stay tuned for another video cast at some point. We'll update you. Protect your capital. This is a tough environment. We're heading into the fall now. Fall is always a difficult time for investors.